let's first talk about your China outlook. I mean, in recent months, you were a little bit more bullish than maybe your peers out there about overall where this economy is going. I think the mood and I think the tone that you strike this time was a little bit more uncertain, it seems. Can you tell us how you feel about China now? What did you get wrong?
Certainly, Yvonne. So and I think it is fair to characterize it as a bit uncertain. Now, I would start by saying that there's actually a number of sectors in China that are going quite well. That includes green infrastructure, other infrastructure, automobiles, and so on. But the key sector, of course, that everybody's focused on, and which is very relevant certainly to our business, is the property sector. Now, in property, we've seen strong completions up 19% year on year. But what's lagging is new starts. That's been recognized at the central government level. There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months, is how effective is that translation of policy into practice. If we do see that starting to take hold, and we think there could be good growth momentum flowing from FY23 or calendar year 23 into calendar year 2024, outside of China, I was in India about a month back. The energy on the ground there, the optimism is palpable. So we're seeing solid momentum in India. Of course, that's a big market for us for commodities like metallurgical coal and for copper concentrate. So overall, we're seeing India and China comprising about half of world GDP growth in the period ahead. And the other point I would note is long-term fundamentals for this sector and for BHP remain really healthy.
Yeah, Mike, we'd like to talk more about the opportunities there in India, because certainly that is a growing market of yours. I just want to pick up, though, on some of the points you're making on China. So, I mean, almost every CEO we speak with is uncertain over the environment there. There's certainly hope, let's put it that way. I want to ask you about what you're seeing across short-term pricing on many of your products in China. What's the outlook on pricing these next 6 months?
So, of course, it's going to depend a little bit on what happens with the overall economy, with demand for commodities like iron ore. There are some rumors of potential mandated production cuts in steel, but it's not like the industry there is starting with high inventories in iron ore or steel. So any cuts that would occur would very quickly start eating into those inventories. Now, obviously, if there was lower demand, that has implications for pricing. But one very important point to note is that the marginal cost of production across the commodities that certainly we produce is higher now than it was pre-COVID, naturally, given the inflation that we've seen in the external environment. So we expect that's going to provide a downside cushion on pricing at a higher point than may have been the case previously. In the case of iron ore, we're saying somewhere between $80 and $100 per ton is likely where the cushion kicks in, given what we've seen on the inflation front. And of course, from a BHP perspective, because we've done a better job in controlling costs than our competitors, we've doubled our lead as the lowest cost major iron ore supplier globally. That higher cushion means that our margins, relative margins, end up being more protected than might be the case for some others.
Mike, what happens if the China property sector gets worse? What does that mean for BHP? Do you think that there's other markets out there? You mentioned the prospects in India. Are they able to at least come up and make up that sort of demand shortfall?
It really depends on the commodity in question, Yvonne. Of course, iron ore, China is the game when it comes to iron ore demand globally. There's such a big, they make up such a big proportion of seaborne iron ore. You wouldn't see that being made up in other markets. However, we are seeing blast furnace utilization run rates in China continue at quite strong levels, about 90%. Even with the weaker growth that we've seen in the second quarter, steel demand remains strong. And we're expecting that we'll see another fifth year in a row of over 1 billion tons of steel production in China. There could be a little bit of downside, as I said, if we do see mandated steel cuts. But even with that, we would expect over 1 billion tons per annum.